If you've had years where you didn't fully use your super contribution limits, you might be sitting on thousands of dollars of unused tax saving opportunity. And you may not even realize it. Today, I want to walk through something called catch-up concessional contributions. It sounds technical, but it's actually quite straightforward. And for people in their 50s, it can be very useful. Most people in their 50s are in one of two positions. Either your income is higher than it's ever been, or you're starting to think seriously about retirement. You start asking a simple question: have I done enough? Sometimes it's both. Catch-up contributions sit right in the middle of those two things, so let's break it down properly. First, we need to understand how super contributions normally work. Each year there's a limit on how much you can contribute into your super at a concessional or pre-tax rate. This includes your employer contributions, salary sacrifice, and personal contributions that you claim a tax deduction for. For simplicity, just think of it as your annual pre-tax super limit. Now here's the important part. If you didn't use all of that limit in the previous years, the unused portion does not necessarily disappear. Instead, it can carry forward. Unused cap space can accumulate for up to 5 years. So if, for example, you were only receiving your employer's super guarantee and didn't make extra contributions, you may have built up unused cap space, and that unused space may still be available to use later, potentially in one larger contribution. There are two key rules to be aware of. First, your total super balance must have been under $500,000 at the previous 30 June. Second, unused amounts only carry forward for 5 years. After that, they expire. That's the structure. It's essentially unused room inside your super contribution cap. Now let's talk about why this becomes particularly relevant in your 50s, because that's often when a few things start to change. First, income tends to be higher. For many people, their 50s are peak earning years. Higher income usually means a higher marginal tax rate. When you contribute to super as a concessional contribution, it is generally taxed at 15% inside the fund, instead of your personal marginal tax rate. So if your marginal tax rate is 34.5% or 39%, there can be a meaningful difference. That difference is where the opportunity sits. This isn't about doing something aggressive. It's simply about being tax efficient. Second, many people have had uneven work histories. You may have taken time off to raise children, worked part-time, run a business with a variable income, or focused on paying down the mortgage. During those years, you may not have maximized super contributions, which means you may now have unused contribution space. Catch-up contributions allow you to use that space later. Third, timing can matter. Income isn't always perfectly consistent. You might sell an investment property, receive a bonus, or realize a capital gain that can push you into a higher tax bracket for that particular year. If you have unused concessional cap available, you may be able to make a larger contribution in that same year, which can reduce the tax impact. That's where this strategy can be particularly useful. It provides flexibility. Fourth, it can help boost super closer to retirement. When you're 5 to 10 years out from retirement, contributions start to feel more tangible. You're no longer building super in the abstract. You're topping up what will fund your retirement income. Even 1 or 2 well-timed contributions can lift your super balance, and compounding still works in your 50s. There is still time for that money to grow. Let's make this more practical. Imagine someone has only been receiving employer contributions for several years. They haven't been salary sacrificing. Over 5 years, they accumulate $40,000 of unused concessional cap. This year, their income is higher than normal. They check their super balance. It's below $500,000. They confirm their available cap space, and they decide to contribute an additional $30,000 into super as a personal contribution. That amount is taxed at 15% inside super, instead of being taxed at their marginal tax rate outside super. At the same time, their retirement savings increase. It's not complicated, it just needs to be checked properly before acting. Before going further, a quick note, this video is general information only. It doesn't consider your personal situation or financial objectives, so it shouldn't be taken as personal advice. If you're considering a strategy like this, it's important to get advice specific to you. There are also a few common mistakes to avoid. First, not checking your available cap amount. The ATO keeps track of unused concessional caps. Those figures should be confirmed before making a large contribution. Second, forgetting the $500,000 total super balance rule. If your balance was above that threshold at the previous 30 June, catch-up contributions cannot be used. Third, assuming the opportunity lasts forever. It doesn't. Unused amounts expire after 5 years. And finally, leaving it too late in June. If contributions are being made before 30 June, timing matters. This isn't something to rush in the final week. If you're watching this and thinking it might apply to you, there are some practical steps. First, check your total super balance as at the previous 30 June. Second, log into MyGov and review your unused concessional cap amounts. Third, estimate your income for the current financial year. Fourth, consider whether this is a higher income year than usual. Fifth, calculate how much contribution space is actually available. Sixth, get advice before making a large deductible contribution. And finally, make sure any contribution is received by the super fund before 30 June and the correct notice is lodged to claim a tax deduction. The process is straightforward, but it needs to be done carefully. The key thing to understand is this: catch-up concessional contributions are not a loophole. They're not a trick. They are simply unused space in your super contribution limits that may still be available. For people in their 50s, that can mean lower tax in a higher income year, a stronger super balance, and more flexibility as retirement gets closer. If you want to implement this properly, I help Australians structure this every day. You can find details below.